You've seen the headlines. Silver war between the US and China, strategic metal showdown, supply chain weaponization. Some channels are framing this as the beginning of a full-blown commodity conflict that sends silver straight to $75, maybe $100. Today, we're going to slow that down. Because whenever the words war and precious metals show up in the same sentence, the hype machine kicks into high gear. And silver, sitting around the low 30s right now, becomes the perfect canvas for dramatic narratives. So in this video, I'm going to break down what's actually happening between the US and China in the silver market, what the data says, what it doesn't say, and how I'm personally positioned. No panic, no clickbait, just numbers and probabilities. Welcome back to Financial Briefing. Before we dive into this so-called silver war, let's do something most channels don't do. Let's keep score. 3 months ago, when silver dipped below $28 after that sharp dollar spike, I said the probability favored a rebound toward $31 to $33 if the 10-year yield stabilized. Silver did rally back above $32 within 6 weeks. That call played out. Back in the spring, when speculative positioning was extremely stretched long, I said upside would likely stall under $35 without a fresh macro catalyst. Silver peaked around $34 at $1.80 and rolled over. That was a decent read. And last year, when recession chatter was peaking, I assigned only a 25% probability to silver breaking below $20, despite some very bearish commentary at the time. We never even got close. So I'm not perfect, but we ground this channel in probabilities, not narratives. Let's apply that same discipline here. If we're talking about a US-China silver war, we need data, not emotion, not headlines. Data point number 1, China's silver imports and stockpiling behavior. Over the past year, China's net silver imports have increased meaningfully, particularly through Hong Kong channels. Depending on the month, we've seen import figures that are 20-40% higher year over year compared to the prior 2-year average. Historically, China has been both a major producer and a major consumer of silver. It produces roughly 3,500 metric tons annually, but it consumes more, largely due to industrial demand, especially solar panel manufacturing. What's different now is the pace. Solar manufacturing capacity in China has expanded aggressively. Photovoltaic installations are at record levels. That directly translates to higher silver paste demand. What it means? China is securing supply to support domestic industrial expansion, especially in green energy infrastructure. That's strategic, but it's not automatically geopolitical warfare. It could simply be industrial planning. What it doesn't mean, it does not mean China is cornering the global silver market. Global mine production is roughly 25,000 metric tons annually. Even elevated Chinese imports represent a fraction of total global supply. They matter at the margin, but we are not seeing an existential supply drain. Data point number 2, US silver inventories and exchange stocks. COMEX registered silver inventories have declined from their 2021 peaks. At one point, we were above 150 million ounces in registered category. More recently, we've hovered closer to 40 to 60 million ounces in registered, with total inventories higher when including eligible. Historically, silver inventories fluctuate significantly. In 2011, during the $49 spike, inventories were much tighter relative to open interest. Today, while inventories are lower than peak years, they are not at record scarcity levels relative to trading volume. What it means? The market is tighter than it was during the post-COVID liquidity surge, but it is not structurally broken. A squeeze is possible in any commodity, but the conditions, right, now look more like moderate tightening than systemic failure. What it doesn't mean, lower COMEX registered stocks do not automatically signal default risk or imminent exchange collapse. Some channels suggest that declining inventories equal paper market about to explode. The data does not support that conclusion, at least not yet. Data point number 3, industrial demand concentration. Roughly 50-55% of global silver demand is industrial. Solar alone now represents around 15% or more of total demand, and that percentage is rising. China dominates global solar manufacturing, controlling over 70% of certain segments of the supply chain. Historically, silver has been more sensitive to monetary demand cycles. In the 1970s and again in 2011, investment flows were dominant drivers. Today, industrial demand is structurally more important. What it means? If trade tensions escalate in technology and renewable energy, silver becomes indirectly strategic. Tariffs, export restrictions, or subsidy battles could shift supply chains and pricing dynamics. What it doesn't mean, silver is not rare earth metals. It is globally mined across Mexico, Peru, China, Russia, Poland, and elsewhere. Even if trade friction increases, silver supply is diversified geographically. That reduces the probability of an outright supply weaponization. So is there tension? Yes. Is it a war? That's a stretch. Now let's look at the bullish case. First, structural industrial demand growth. If solar capacity keeps expanding at double-digit rates globally, silver consumption rises regardless of macro cycles. Efficiency improvements reduce silver per panel over time, but total installation growth has been offsetting that decline. Second, geopolitical fragmentation. If US-China relations worsen, strategic stockpiling becomes rational behavior. Governments and corporations both could build inventory buffers. That pulls forward demand. Third, monetary instability. If US deficits continue expanding and real yields fall, silver benefits as a hybrid asset, part industrial, part monetary. In prior cycles, silver has outperformed gold late in liquidity-driven rallies. Fourth, supply constraints. Silver is often a byproduct of copper and lead mining. If base metal production slows due to economic contraction, silver supply could tighten unexpectedly. Put that together, and I see a 30% probability that silver breaks sustainably above $38 within the next 12-18 months, driven by a combination of industrial demand and macro easing. Not 70%, not 90%, about 30%. Now the bearish case. First, global slowdown risk. If China's property sector weakness deepens or US manufacturing contracts further, industrial demand could soften. Solar growth could slow under subsidy pressure. Second, stronger dollar environment. If the dollar index pushes higher, say above 110, silver historically struggles. A strong dollar tightens global liquidity. Third, rising real yields. If the 10-year Treasury yield climbs back toward 5% and inflation moderates, the opportunity cost of holding silver rises. Fourth, speculative excess. Silver is a volatile metal. When positioning gets crowded long, corrections can be sharp and fast. 10 to 20% in a matter of weeks is not unusual. Given those factors, I assign about a 35% probability that silver revisits the $26 to $28 range before making any meaningful upside attempt. Now the middle case, which is where I lean, I think the most likely outcome, roughly 45% probability, is a broad range between $28 and $38 over the next year. Continued US-China friction creates headlines and volatility, but not systemic disruption. Industrial demand grows, but at a manageable pace. Monetary policy gradually eases, but not dramatically. In other words, volatility without collapse, tightness without panic, opportunity but not chaos. Let's zoom out historically. The closest comparison people make is the late 1970s commodity tension period, when geopolitical uncertainty, inflation, and supply fears all collided. Silver exploded to $49 in 1980, largely driven by speculative concentration and monetary instability. Similarities? Elevated debt levels, geopolitical rivalry, concerns about currency debasement. Differences? Today's global supply chains are far more diversified. Financial markets are deeper. Regulatory oversight is stronger. And silver's industrial demand profile is structurally different. Another comparison is 2011, when quantitative easing and Eurozone stress drove silver near $50 again. That move was heavily momentum-driven and speculative. When margin requirements changed, price collapsed quickly. Today, speculative leverage appears more moderate. We don't see the same retail frenzy, at least not yet. Now, cross-market context. Gold is trading near record territory relative to the last decade. When gold leads and silver lags, that often signals defensive positioning rather than inflation panic. The dollar index has been resilient, not surging, but holding firm. That caps silver's upside. The 10-year yield has been volatile but remains historically elevated compared to the 2010s. Until real yields decline meaningfully, silver's monetary upside may be limited. When I synthesize those signals, I see a market that is cautious, not euphoric. Positioning context matters too. Commitment of traders data shows commercial hedgers moderately net short, which is normal, but not at extreme levels. Managed money longs have increased, but are not near historic extremes. In past blow-off tops, we've seen speculative length spike aggressively. We're not there. So how am I handling this? Here's my framework. If silver breaks and holds above $30 on strong volume with declining real yields, I will increase allocation by 5 to 7%, targeting an upside move toward $45. My take profit zone in that scenario would be $44, $47. If silver drops below $28 with rising dollar strength, I will gradually add physical exposure in tranches, assuming no structural breakdown in industrial demand. My stop on leveraged instruments would sit near $25. Currently, my allocation to precious metals is about 18% of portfolio value. Of that, roughly 60% is gold, 30% silver, 10% mining equities. Not advice, just my framework. And here's what I'm not doing. I'm not panic buying because someone says war. I'm not consuming fear-driven content that assumes systemic collapse as the base case. And I'm not assuming that every geopolitical headline translates directly into metal shortages. Markets are complex. They discount gradually. This week, here's what I'm watching. First, Chinese import data. If we see another month of 40% year-over-year increases, that strengthens the structural demand narrative. If imports flatten, that weakens the stockpiling surge argument. Second, U.S. 10-year yields. A sustained move below 4% would support metals broadly. A spike above 5% pressures silver. Third, dollar index behavior around key resistance. A breakout higher would likely cap silver rallies. A breakdown could fuel momentum. So let me summarize. There's increased tension between the U.S. and China. China's industrial silver demand is rising. Inventories are tighter but not collapsing. Probabilities favor range-bound volatility, not explosive breakout. Silver is strategic but not weaponized, at least not yet. If you appreciate calm, data-driven analysis without the drama, subscribe to Financial Briefing. We break down markets with probabilities, not predictions. I'm watching the numbers. I'm adjusting as data changes. Stay sharp. The hidden U.S.-China silver conflict. What it means for prices in 2026.